This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
Thanks for joining us once again for part 2 of our interview with John Burns Real Estate and Consulting CEO, John Burns. Enjoy.
When the pandemic hit, what was your initial reaction as to what we're about to see for the rest of the year? And how differently did it play out, or did it play out the way you thought?
No, it didn't play out the way anybody thought. So
I'm relieved to hear you say that.
Fortunately, we were in the business, and I had 70 plus smart people. We were paid to be people that figured it out. So people were coming to us to figure this out, and we had the time to figure it out and the resources and the know-how. So on that sense, I feel really lucky. And we started doing weekly webinars to educate our clients on what was going on. But the federal government was asking me to believe, and this is before it actually happened, that the IRS, which has to be one of the most bureaucratic organizations out there, whose budget had been slashed, was going to magically get a check into everybody's checking account, a deposit into everybody's checking account. And the Small Business Administration, which probably is just second to the IRS in terms of a slow-moving bureaucracy, was going to pay all the payroll for all the small businesses in America for 2 months. And I said, I just don't buy that. I mean, it's a great idea. It's crazy. You know what? And then they pulled it off. And they did that. They paid all that payroll for 2 months. The Fed started gobbling up more mortgage-backed securities to get interest rates down and dropping their rates. And the analogy I drew, I thought it was going to be Armageddon until those checks actually started depositing. But the analogy I drew was going back to my earlier days, the 2001 downturn, when Greenspan dropped rates, the Fed funds rate was 6.5 and it went to 1.
Right.
13 years after the S&L debacle, or maybe 10 to 13, depending on where you are, and housing was in very similar shape. It was in balance when Greenspan did that because of the S&L crisis. Housing took off. And you started this conversation with that. What happened 2001 through 2006? That whole thing got started by the Fed dropping rates, using housing as an impetus to grow the economy, to offset all the other stuff that was going on. And I said, here we go again. This is the exact same thing. But I don't want to sound like I called it, because everybody, especially my wife, will tell you I thought it was Armageddon in March. It wasn't really until we suspended our forecasts. And I think we released them at the end of May, or probably early June. And I'm really glad we did, because we would have been completely flying blind. But by then, I'll tell you, so Orange County home sales, new home sales went from 103 a week to 3 in a couple of periods. Yeah. By then they were back up, not maybe at 100, but at 80 or 90. I mean, the market recovered really quickly.
Oh,
so that made us a lot more confident.
It was amazing. Now, what's interesting is looking at this, one of the things that I knew was not correct is that, California's floated around 400,000 sales for the last decade, plus or minus, 20,000 or something. And the reason was given by people that were doing presentations that we didn't have enough inventory. So what happened in basically March and April and May, inventory went down 45%, and volume for the rest of the year kind of kicked along at an additional 20%. So it got to about 480,000 units. Yeah. On 55% of the inventory. The demand landed on that small of inventory. So I think you had two groups that were urgent. There was a group of urgent people that said, you can't go see my house now. It's being pulled off the market, not going to show it. And there were another group of people that said, I have to get out of wherever I am and urgently buy one. And I think those two urgencies collided.
Yeah, I mean, if you asked a home builder what was their number one wish, it would be that people would save a down payment. So all of a sudden, people stopped spending money because there was nowhere to go. They didn't take a vacation. They got a stimulus check. You only need 5% with FHA. They got a down payment. The mortgage rates would go below 3, which they did. That everybody would be locked in their house and stare at their ugly kitchen with the entire family all day, and then be forced to be on Zoom calls while your wife's running the blender. and all of that combined to I believe a lot of people said, we're thinking of moving anyway. Now's the time.
Or the other thing happened is let's fix the place.
Big time.
Yeah.
Home Depot, $100 billion a year in sales, saw a 23% year-over-year surge in demand during a pandemic when they were limiting the number of people that could come into the store.
So that's, we have people listening to this, and for this next section, this is what they're very interested in. So I've been looking online, trying to figure out what's going on with the prices of the lumber and all that stuff. So I started reading about it. So one of the things that happened was construction of homes was considered a necessary business. So they could continue, correct? Okay, and Home Depot was a necessary supplier of their stuff. So they were allowed to open, even if it was a limited, they were still allowed to do that. You did have that group of people that stayed home and looked around and said, I think we need a new kitchen. And they did that. What was interesting about that is that they didn't open the supply chain. The lumber yards were not necessary businesses. So all that demand landed on a business that couldn't play catch up right away. Is that accurate?
I don't think the lumber yards were closed because I think they were a part of construction. So we've got a guy, Tim Sims, who actually for a long time worked in a lumber yard before he went back to college and worked for Nichiha, and now he's with us. He put together this, and we did a whole 20-minute segment for our clients last month on inflation and what's going on in the supply chain. And there's more to the story than this. So okay. The tariffs started in the 80s. There were a bunch of beetles infestations in the 90s. During the great financial crisis, 150 sawmills shut, and a lot of them were never reopened. Then, particularly in the West, we had all these fires. Then we had a bunch of environmental regulations that were restricting habitats. So that just leads up to the pandemic. And we weren't building that many homes, so lumber prices had never really gone out of control. Well, then during the pandemic, a lot of the mills shut down. Frankly, it was more the social distancing was my understanding. They just couldn't make it work. And like me, they thought, I have more mills than I need.
Right.
So I'm going to shut it down. Then they have to, when they reopen them, they have to have COVID precautions. So you're right, there was a supply shock, if you will. And at the same time, the government induced a demand shock, not only for new construction, but also for remodeling. And it was a perfect storm. Less supply, more demand. What happens to home prices? And what happens to lumber prices?
Now, where do you see that headed for the rest of the year? And what supply chains are not only lumber, because we've been involved in finishing homes, and appliances have been difficult to get and that type of thing.
I mean, I'm just going to repeat what my building products guys have educated me on. Those mills that were stopped in the spring of last year are restarting and coming back online. So we're going to see some more supply there.
So they've been stopped for like 8 months?
No, I'm not. I mean, every mill is different. So
okay.
I'm not exactly sure.
Okay.
But we are going to see supply come back. But demand is surging at the same time. So the bottom line is they don't think it's going to change very much. You talked about the appliances. What the rumor is, but it's from a good source, that one of the builders actually ordered like a year's worth of appliances from one of the appliance manufacturers and shoved them in a warehouse because they were not able to close homes due to lack of appliances. So they essentially hoarded all the appliances.
Okay.
So a big home builder that builds, tens of thousands of homes a year can hoard appliances, making it hard for you and me when those appliances are stuck out on a boat or not being shipped from China.
Okay.
So there's a big shortage there. And I've learned that there's apparently a chemical shortage that's coming, and a lot of raw materials need chemicals. So we're not out of the woods in terms of shortages here.
How are the builders reacting with their clients? So they have a client interested in buying a new home. How do they fix the price and sign a contract?
So that's the big debate. So I know a couple private builders that were ecstatic about their home sales last year, but didn't lock in their costs.
Oh, wow.
So they agreed to sell a home at a nice profit margin. And by the time they got the home built and closed, there wasn't much profit margin left. So pretty quickly, they learned, let's not sell too far ahead of construction because I'm taking all that construction cost risk.
Right.
So they just started jacking prices to slow it down, or just limiting sales altogether, because it's really hard to raise prices 10% and then take them back 5%. So prices were ratcheting up pretty quickly, but what I've seen this spring is they're ratcheting up even more. There's one publicly traded home builder that announced publicly they've got, I think, close to 150 communities. They raised prices 5% in 5 weeks across the entire portfolio.
Wow.
Just to slow down sales. And they slowed them down to only being up 27% year over year instead of something like 80.
Okay. But they could easily have a 5% price increase during that too, correct?
They could. Yeah.
Okay.
And their goal was actually to sell fewer homes, because I can't deliver them, frankly, for probably a year at this point.
Yeah, it's interesting. We've been building homes in Florida, and so you've had delays that you think, okay, well, I couldn't have dreamed that one up. So there's health inspections in Florida. The people that their health inspectors were taken off of what they normally did to give shots.
Sure. Yeah.
So you.
Fuse boxes is another one. You don't think about some of these things, that these little tiny components that come from other countries. You can't close a house without a fuse box.
Right.
There was a story in the Wall Street Journal talking about the freeze in Texas is going to slow down PVC or materials, things like that.
Right. There's chemicals and things that go into the manufacture of that. And yeah, I think there were some problems there before the pandemic that just got accelerated during the pandemic.
Would it be fair to ask what a typical margin of profit is to a national home builder?
Sure. There's like 25 of them. You can look it up. They've all got publicly financial. I think it's about a 10% profit margin.
Okay. So if they get a big price increase, it's not like, okay, we can absorb that and be completely fine. That could be a big chunk of what they make.
Yeah. But remember too, that a lot of the cost is the land.
Sure.
So if I raise prices go up 5% on a $300,000 house, that's 15 grand more in revenue.
Right.
Prices go up 5% on 170 grand, which is your cost, not land.
Right.
That's not as much. And
Right.
so there is if the percentages go up the same, their margins will grow.
Okay. Got it. Okay. You had said right at the very beginning that you were seeing kind of the same signs that we did toward the last peak. So what are the things that you look for? I'm not saying it's the same situation, but what are the charts that you pay attention to say, oh, I mean, we're closing in at the peak again?
Yeah, I want to rephrase that, because I didn't say the same signs as the peak. We were talking about the early 2000s. So
okay.
At the very beginning of that, when you started to see double-digit price appreciation, that's what I'm seeing.
That's what you're saying again. Okay, so you're not seeing anything like a 2006 or 7, and I don't mean an event, but you're approaching that price. So, okay, give me a, do you think we're in 2002 or 3 in the cycle?
In terms of volume, yes. So, in 2006, we were near all-time high levels of construction. We're not anywhere near that. And downturns are really, really bad when you have 2 million empty homes that need to be filled.
Yeah.
We're not doing that. The affordability in relation to income is out of whack in most of the country, but not nearly as out of whack. And I'm talking about the payment now, not the price, as it was in 2006.
When you say out of whack, you mean the payment's maybe a little higher than it typically is, but it's still okay in the margin.
Yeah. If you look at the ratio of payment to income in each area, most areas it's slightly higher than normal right now, thanks to very low interest rates.
Right.
But what happens if we see double-digit price appreciation for the next 3 years and incomes grow 3% and mortgage rates stay flat or go up a little bit? You could see payment in relation to income grow by 40% or more. That would be 2006-ish all over again.
Do you think the lenders have the ability to say yes at that level? Or the policies in place that would just tell them, I know you want one, but the answer is no?
Mortgage lenders?
Yeah, mortgage lenders saying to buyers, I know you want one, but you can't get a yes answer right now.
Have you ever met a mortgage exec who didn't want to grow?
No, but I did meet a few that decided they didn't want to not be able to sell their loans. In other words, are there policies in place you think that will let that go? I mean, so prices can go? So,
I mean, you hit the nail on the head there. Mortgage companies originate mortgages and get them off their books as fast as possible.
Right.
So I don't think the mortgage guys are very incented to de-risk, as long as they feel they can get a pool of mortgages and find a buyer. The de-risking will be done by Wall Street or whoever, or the Fed, who's now buying those mortgages.
Okay.
But who buys those mortgages is generally debt-oriented pools of capital, whose alternatives today are what, 1% treasury rates.
Right.
So to get a 3% mortgage is huge yield compared to treasuries. And that's the same thing that happened last time, is that all those subprime mortgages that you and I, and actually a friend of mine was the head of a company that was doing a ton of them, and he quit because he knew this was the end.
Right.
But Wall Street just kept going because there was somebody to keep buying it. So the ultimate regulator, I don't know if the regulators can actually come in and stop this. If things get out of control, it would have to be nobody's interested in buying them anymore.
What's really interesting right now, again, you and I have a pretty good historic memory of the chart. So the projections of GDP growth to me I've been astonished by. So I was interviewing Doug Duncan, and Fannie Mae has a 3-year projection of GDP. So January of 2020, they looked out to 2021 and said 2%. January of 2021, they looked out and said 6.5.
Yeah.
So 12 months later, we've gone from 2 to 6.5. And I mean, because I really respect him, I had to sit down and think about that instead of just going, well, that can't be right. So, and now I think somebody came out from the Fed, or somebody was 7 and something.
Yeah.
Now,
I would take the over.
Yeah. Now, what's interesting? Okay. Now, why do you think that is the strength of the economy? Because of the money that they're shoving into it?
Absolutely. Two things. So we think, and actually there was a great New York Times article on this using good Bureau of Economic Analysis data that we did a summary of for our clients. So I've got it memorized. Basically, on average, because there were some people that really struggled last year, but on average, Americans made $1 trillion more last year from February to November than they had made the prior year, mostly due to government stimulus, to handouts. And they had spent $535 billion less because they were stuck in their house. So you add it up and you get almost $1.6 trillion in additional savings, and that's, JP Morgan is publishing how much everybody's savings accounts are up by quintile. Even the lowest income bracket, their savings accounts are up, and people have been stuck in their house.
Yeah,
So you got all this cash. What are you going to do?
interesting.
My son works in an escape room, which, by the way, they're still open. And he said, as soon as those checks hit, we got booked up to the max because everybody just wanted to come in and play.
Yeah,
And I think that's exactly what's going to happen.
okay.
I saw that infographic. You guys put out such great infographics.
Now, let's get back to, when's the last time we had GDP growth at 7.5% or 6.5%? It's 1984.
Okay.
And interest rates were slightly different in 1984. So the Fed fund rate is 10 and the mortgage rate was 12. Can you put John back on the main screen, Joey? So what business do we have at a 0.25% Fed fund rate?
Now you're above my pay grade, Bruce.
Well,
You've got one of the best track records of crawling interest rates of anybody I know. So I'm gonna let you answer your own question.
well, I think it's completely manufactured, and that's what's scary. So we have no business being at a 0.25% if you have a 7% GDP growth. That'll be really interesting. Do you think the Fed's going to entertain, what is it called, Project Twist, or Operation Twist, where they buy the 10-year and drive interest rates back down for the mortgages?
Well, let me challenge you a little bit on the interest rate thing. So we mentioned, it's $1.6 trillion in savings. Where is that going to go? So that, all that capital is seeking a home in banks and other places. And I think that's what's driven interest rates down, is there's so much demand for yield. And going back to your earlier comments about the trend in build for rent, that's what we're seeing, is people are saying, you mean I can invest in houses with yield versus, something that's only backed by a promise of the federal government, or something that's, not yielding very well, or there's negative interest rates all around the rest of the world. I think that's an important part of this discussion, Bruce, and why home prices are growing up, is we're seeing investment capital flow in to something, frankly, that makes sense to invest in my view, compared to other investments that are out there.
Okay. Well, that's why I love to talk with you, because, like I said, some of the stuff I look back and go, okay, well, what in the world are we doing at a 0.25%? It just seems so manufactured we have to have this outcome. So how do we get there? Let's pretend we don't have. Are you concerned about inflation then at all?
We're very concerned. I think we have inflation right now. It's not across every single product. I don't think it's super heavy in the non-discretionary items like food and rent, which is growing, but not substantially. But in discretionary items like buying a house, or I bet, going out to dinner, all those things that are going to be in huge demand. I bet the airline fees are going to get very expensive. Assuming this second, we don't have a second round of a different strain of the virus coming through, and people are really going to go out and spend, I can see revenues and costs going up pretty substantially.
What's interesting, I haven't ever checked this source for what my feeling is about the economy, but a gentleman happened to go look for a boat to purchase in March, and talked to the boat dealer who had 700 boats on the lot. And he was busy. And 2 weeks later, the coronavirus hit, and he lost all of his sales. And he literally was depressed, thinking he's going to go out of business. By the end of May, he had 50 boats left.
Yeah, and there's a boat shortage. So he's raising his prices on his boats.
That's right. Again, I think, do they make them out of wood? Probably do.
John, Bruce just interviewed David Kittle, and one of his big concerns about throwing all this money at the economy was that when somebody gains, somebody loses. So he's really concerned of the losers. Who do you see? Do you see a loser on the other end of this?
From a consumer standpoint, the winners are the ones that just locked in a sub 3% mortgage rate for the next 30 years and are confident they're going to be able to maintain employment. And the losers are probably, and home prices went up because of that, and losers are those that haven't done it yet. You know, particularly those maybe who are in college or something and aren't ready to do that yet, will probably be coming into a very expensive housing market.
Do you think interest rates will gradually go up or down? I'm just curious.
So I look to the futures market and the bond market, and the bond market is projecting they'll go up about 60 basis points over the next 3 years. So I'm going with that.
Okay.
I'm not smarter than the bond market.
Well, that's interesting. So if the Fed comes in and buys those,
Yeah.
then they can reverse that, and that's kind of been talked about. So,
But I think the bond guys know that.
oh yeah,
That's my point. Is they're figuring all this stuff out, you know. But the bond market has been forecasting increases for quite some time, and obviously they've been wrong. But I'm not going to say that I somehow am smarter than a bond guy.
you know what's fun about what you do is you sit across from people that rely on the information that you give them, but you're sitting across from the table from the smartest people in our country. And so what's nice about that is you see how they think and how they operate and how they react to challenges. And that's worth I don't know what, in just for your own benefit to see how they do that.
Well, that's why I love my job. Yeah.
Absolutely.
I learn so much from my clients every single day. And then, you know, I get the good fortune of kind of pulling it all together for everybody, because they all look at the world with a different lens.
Yeah. The best thing I've ever heard anybody say that does what you do is that you once told me that you don't give much thought to what you know. What keeps you up at night is what you don't know.
Yeah.
And if somebody's looking for a consultant, they can't do better than that. They just can't.
I borrowed that from Warren Buffett. He said
Well,
it better than that. Yeah. But that is how you lose money. Is there's something going on that you're not aware of, and there's always something going on you're not aware of.
yeah, absolutely.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.
The Norris Group originates and services loans in California and Florida under California DRE License 012-19911, Florida Mortgage Lender License 1577, and NMLS License 1623669. For more information on hard money lending, go to thenorrisgroup.com and click the Hard Money tab.